Joined today by Anil Stocker, CEO of Market Finance. Thank you for taking time out of your busy schedule to talk to me. I'm hoping to get some great insights and your thoughts on the market today as it is impacted by COVID-19. So thank you for joining me.
Great, thank you for inviting me. Looking forward to it.
Great. We're a broker. We do lots of business and have been doing lots of business for the last few years. COVID-19 came along and we've seen lots of lenders simply stop lending. You're not one of those. You're still active, taking on new business. What makes you different?
Well, look, I think we're trying our best. The market has really changed very quickly. No one can predict this COVID crisis, and it's hitting the real economy very hard, very fast, with small businesses bearing the brunt of a lot of the dislocation in the market. So what we did is, we specialize in invoice finance, receivables finance. That's what we've been doing since 2011. And we have built a track record. We have good relationships with our funders, and they trust us, and they've got data from us for many years. But we're helped by the fact that it's relatively short duration and it's secured, right? Against, it's primarily we're funding goods and services that have been delivered. So as long as those goods and services continue to be delivered and signed off on, payment should come. And that's really why we have been focusing double down on invoice finance to keep funding going to our existing customers, and also to keep funding going to new businesses, especially if they fall within sectors that are actually seeing an increase in demand. Food and drink, into the supermarkets, healthcare, pharma. We're supporting a lot of health companies that have pivoted towards supplying health goods, be that PPE or other disinfectant and masks here in the UK and across Europe. So what we're trying to do is we're trying to prioritize sectors that are battling COVID, that are seeing a real need for finance right now. And we're having to obviously be careful in sectors that are not doing so well at the moment because of the lockdown, be that construction, be that hospitality or events, into those travel, into those supply chains. So we've taken a proactive approach. We're trying our best to help. Liquidity, did slow down a little bit, but now we're seeing it, come back from that initial panic and stabilize. So I guess to summarize, the nature of our product means that we can keep going. Invoice finance is pretty resilient in a downturn, and it's relatively short duration. And then because market finance has been in the market for so long, we're able to leverage those relationships with our institutional funders to keep funding.
That's good. Have you had to adapt any of your processes? Particularly, I'm thinking like onboarding new clients, which sometimes require visits to sites. Have you had to adapt that with the social distancing?
Yeah, absolutely. So we're a FinTech business lender. So when we started, we built the sign-up process really to be, as much as we can online or assisted by telephone. And that's serving us really well now because we can continue working like we used to work. We also invested quite heavily into integrations with accountancy systems, which means that we can do audits, and we can run analysis by computer to computer, desktop, and that means that that's also more efficient right now in these times. So I would say that we're digital first. Of course, we've got great people in our company and are talking to people, accountants and producers in the market as well as end customers, and we continue to do that. But we haven't had to root and branch change our processes because our processes have already been quite online the past few years. But other things
innovative is pretty second nature to you guys anyway, isn't it? So
yes, we try to be. We try to be at the cutting edge, and if we can do stuff online, whether that's signing, documentations through DocuSign, we invested in all of that very early on. We're trying to strip out all manual, offline processes so that we can be there for business owners no matter what time of day it is, and whenever they need us.
Okay. And leading on from something you just mentioned earlier on about your funders and your backers, one of the questions we get commonly asked is, our interest rates have dropped, our borrowing rates dropping, and in some cases they're not. A lot, the lending rates are going up. How are you finding that? Are you having to adjust your rates for risk or because of the funding market and the cost of funds have gone up?
Yeah, look, absolutely. In periods of uncertainty and in downturns, there's increased risk in the market. And when there's increased risk, funding providers, liquidity providers demand a premium to compensate for this risk. And so, as a small business focused lending platform, we have had to increase the rates, slightly. We hope it's only temporary. Because we hope that's rationality, things will calm down, we can lower those rates. So, doesn't mean that we increase the rates. It's not like a permanent increase. It's a temporary one. Why? Because we want to keep the funds flowing, and investors need a little bit more yield to compensate them for the risk. Otherwise, they're just going to move their money into other things, which is what we don't want. We want the money to stay going into the small business community rather than, for example, buying gold or going into equities. So we do have to increase the yield a little bit, but it's not for all sectors. Some sectors, good companies will still see competitive rates, and the other thing, by the way, is this is why there's a very good reason for the government to intervene through schemes like CBILS, COVID Business Interruption Lending Scheme, which gives a guarantee to investors. So if we can become part of that scheme, which we're working very hard to become part of that, then we'll be able to show our institutional funders that we've got a guarantee, 80% up to 100%, and that will drive back down the yields because investors will feel more comfortable.
And are you partly actively promoting the government to support that fintech sector for producing and providing those CBIL loans, other than the banks? You're really pushing for that, I'm assuming, because I think that'd be great for everybody.
I think absolutely. Look, I'm saying to government is that fintech was born out of the last financial crisis. That was when the movement started after 2008, 2009. You saw great new entrants, and now we've become quite big players, and we're servicing the smallest businesses, which are not very well served by the banks. And we've invested in technology to be able to process a lot of smaller loans to these businesses, smaller invoice finance facilities. Often we're servicing them when the banks won't even entertain a discussion with them, or will just take too long to get them set up. So the government really should be embracing, in this crisis, working with these fintech platforms that were created in the last crisis. Now's a good time to work together. The good news is that we're very much on the radar of the British Business Bank, the Treasury, and we hope also the Bank of England, because people forget that the banks can go and borrow from the Bank of England. They can go and get money from the Bank of England at close to 0% to lend it out. Fintechs can't access that borrowing window. I really think that there's a very good case for fintechs like Market Finance to be able to get those cheaper funds and then use those cheaper funds to deliver cheaper rates and more funding into the small business segment. We've done nearly 3 billion of funding through the platform. There's no reason why we can't do much more. And we've stood the test of time. We've been here for close to a decade, so we're well placed to do that, and hopefully that will be the next step with working with the government.
Okay. A last question for you then. You've already mentioned it or touched on it. Fintech business, lenders like yourself, and you were one of the leading ones, came out of the last crisis, 2008. Might be early days, but any predictions from you? Is this going to cause any more seismic changes? What do you think is going to happen coming out of the back end of this?
So, look, the nature of this shock is very sudden and very deep. And what tends to happen when industries get disrupted like this is that you're going to probably see the best fintechs kind of surviving and showing that they can survive through a downturn, survive this, keep going, and are here to stay. And I think you're going to get when you're coming out of the crisis, players like ourselves and others will see a great opportunity to kind of be aggressive coming out of the crisis and pick up even more customers and, really kind of come at it strong. But equally for smaller players or weaker players, there might be some consolidation, or there might be some people failing because, this kind of crisis doesn't take any prisoners, right? It's quite grueling. You need to make sure that your company comes through it. So I would imagine that after the crisis, there could be some platforms taking over other platforms, some consolidation, some coming together. You've seen digital banks alongside fintech lenders. At some point, do they work together? Will you see more partnerships as well? I think it will be a catalyst for a lot of partnerships. We've partnered with the likes of Barclays in the past. There are other banks who probably want to address their product set and partner with us. So I think it's going to be an interesting period coming out of this. And if you're a business right now, you should just look carefully who you're borrowing from, and make sure that they're long-term partners for you.
Okay, that's great. Thank you very much. I mean, that's great insight, and I wish you well, and hope that you can continue lending to businesses as you do and supporting them. So thank you very much. Thank you for your time today.
Thank you, Richard. Thanks a lot.